The Chicago Business Barometer held on to most of July's gains, falling just a fraction to 54.4 in August from 54.7 in July. While still below the highs seen towards the end of last year, it is still consistent with the bounce back in activity in the third quarter, following recent weaker growth. It was a slight easing in both production and new orders which prompted the latest barometer decline, with both pairing some of the large gains seen in July that had left both measures at the highest level since January. While new orders and production may have softened in August, both remained above the 12-month averages and significantly up from the depressed levels seen between February and June. Production was also above the 10-year average in August, and new orders was only slightly below the decade-long measure. Part of the resilience in production and new orders was due to stock growth, as companies accumulated inventories of finished goods at the fastest pace since November 2014. Were they planned or unplanned? Feedback from companies was mixed, although our assessment is that the overall positive tone of the survey is consistent with deliberate stock builds in anticipation of strong demand coming in the fourth quarter. Order backlogs fell slightly, remaining below the 50 break-even level for the seventh consecutive month, with companies seeing some slack following the weakness in orders earlier this year. Supplier deliveries jumped into expansion to the highest since March, having spent 3 months in contraction. This move was seen as suppliers did not have the right mix of needed products readily available for delivery. While July's surge in output and orders helped push the August employment component to the highest since April, it remained in contraction for the fourth consecutive month and was still close to June's 5.5-year low. While typically we'd expect employment to follow output higher, according to a special question asked in August, 63% of our panel said they do not plan to expand their workforce over the next 3 months. This suggests that companies are still not yet convinced enough that growth will continue to commit to taking on new workers. A fall in oil and other commodity prices meant that the recent increase in prices paid proved short-lived. More companies thought that prices had fallen than risen between July and August, with the proportion seeing an increase at the lowest for more than 6 years, and prices paid falling into contraction after 3 months of expansion.